It could have been worse, but it's definitely bad.
6.1%.
Yep, another nasty set of numbers.
This inflation outcome today mirrors the lived experience of Australians who are doing it tough right now.
And the really bad news for struggling households, non-discretionary inflation is even higher at 7.6%. That means the stuff you can't really do without, think food, fuel, shelter, is getting more expensive more quickly than the stuff you don't need, like new TVs, jet skis and the Ab King Pro.
One of the fastest and easiest ways to get the flat, sexy abs you always wanted.
Things we can't avoid, that's running a lot higher, which means for particularly those low-income households and those households on fixed incomes, these price rises are really hurting.
If you think that might make the Reserve Bank go easy on rate rises, think again.
The Reserve Bank's kind of got one job, and that's to control inflation, and it's got one main lever, and that's interest rates. Higher interest rates won't push down the price of petrol. Higher interest rates won't make lettuces more available when we want to buy them. We have to be really careful that the Reserve Bank doesn't over-respond to this problem and pull hard on a lever that's not really connected to the things that we're trying to influence.
But right around the world, Reserve Banks are doing likewise in a desperate bid to curb runaway inflation. And that, along with, everything else, has prompted some seriously gloomy global financial forecasts.
The IMF's warning that the world could be heading for a recession is all the more reason for Australian policymakers to be cautious.
All in all, it's left the new government wedged firmly between a rock, a hard place, and an even harder place.
It is not possible to clean up 9 years of mess in 9 weeks. It will take time for us to get on top of these issues, but we will get on top of them.
Martin North is a finance analyst. Martin, it's already so tough for so many households. How much worse do you think this could get?
I do fear it's going to get worse from this point. The inflation was big today, but it's going to get bigger, I think. We've got the interest rates rising quite fast, and I think they're going to rise even more ahead. And, of course, wages aren't really growing in real terms. People are going backwards. So many households are now very much caught in this perfect storm of, financial distress, frankly.
The lever that the RBA has to pull when they're trying to fix inflation is interest rate increases. But what good does that do when inflation is highest on the things that we don't have a choice to spend money on?
Well, there's a very interesting question. The old thing about if the only instrument you've got is a hammer, everything that looks like a nail, that's the problem here at the moment, because effectively interest rates are trying to dampen down demand to try and actually get inflation back. But inflation is being driven by supply chain disruption from overseas. It's being driven by the Reserve Bank's easy money for many years, a lot of stimulus. So it's not necessarily going to work the way that they hope.
Martin, there are a lot of people like me who don't have a mortgage or own a home that get excited when people talk about mortgage stress. I just picture people with mortgages having to sell their homes at low prices and then maybe I can get in. Could this actually be a good thing for people who don't own a home?
Well, you have to look at it around the traps. You've got about a third of people with mortgages, about a third of people who have property and no mortgage, and a third of people in rent. Now, rental stress is rising. That's not good for the economy. Mortgage stress is rising for those people who actually have mortgages. So the overall economic momentum in the economy is going to get weaker because of that. Because what happens is people hunker down, they spend less. And that's not good for anybody, whether you're actually looking to get into property or whether you're actually not.
Martin, I apologise for Tom's disaster capitalism. I didn't realise he was such a vulture. And I think it was unbecoming of him to ask that. But my question...
Homeowner over here.
Well, mortgage stress is interesting though, right? Because it's a hugely sensitive thing for a lot of people, because once you suffer mortgage stress, you have this big debt. And if you can't pay it off, especially if house prices are falling, this can wipe people out. How quickly is mortgage stress going up? When the interest rate goes up a little bit, how many more people does that put in peril?
Yeah, it's a horrible story. So if you go back 20 years, there were about 15 to 20% of households in mortgage stress, 32% before COVID, now 45% of households. That's 1.6 million households. And just to give you a bit of an idea, if rates go up 1% on a 30-year mortgage, that's equivalent to a 15% increase in the monthly repayment on that mortgage.
So, Martin, as individuals, what should we actually do other than selling a PlayStation 4? Should we just wait for these supply pressures to evaporate? What do I do?
So it's clear to me that many households could do things differently for their own household budget. So, for example, many people with a mortgage don't actually have the best possible mortgage they could actually get, in other words, the cheapest. Shop around. The second is that only about half of households actually run a cash flow, so they don't actually know where the money's going, where it's coming. The third one is prioritise. So if you've got debt on expensive credit cards, paying 20% or something, get rid of that first and pay down expensive debt. So you've got to plan now for more pressure ahead. And actually, those households that do that will be much more able to weather the storms ahead.
All the best, everybody. Martin, thank you so much for your time.
Thank you.